Well, hello friends. In this video, I want to talk to you about a query that many of my online family members have sent. And I can understand, I can relate to your concerns, your worries, your anxieties, because September is the last month when you're going to be trading with STT and CTT, the Securities Transaction Tax and Commodities Transaction Tax at the present levels. Come 1st October, your transaction taxes are going to go up, and probably by the end of September, the SEBI board is likely to finalize its decision on the derivative lot sizes in futures and options of stocks and indices. As per Financial Express news reports, it seems that SEBI has decided to keep the original proposed lot sizes to be increased in two phases, phase 1 and phase 2. Phase 2 will of course be implemented after 6 months after phase 1 has been implemented. So indications are, and like I remind you, this is just a news report as of now, that in the first phase, the derivative lot sizes will go up between 15 to 20 lakhs per lot, and in the second phase, which is 6 months down the line, it will be 20 to 30 lakhs per lot. Now, a lot of traders are worried, which is of course they should be, because your capital outlay per lot is going to go up, averaging is going to become difficult, hedging your portfolio, delivery portfolio with covered calls is going to be difficult, and more importantly, to full-time traders who trade for a living, they are basically worried whether they should start trading another asset class altogether. And the thing that comes to many traders' mind is, Vijay, can we start trading commodities? Well, in this video, I'm going to answer your question about that. Now, before I proceed in this video, let me apprise you of some things. This is not a boasting ride. I'm just telling you about a few things about myself and whether I'm competent enough to answer your question. So I am the first author in this country to have written a book on commodities trading, which is sponsored, approved by the NCDX, the National Commodities and Derivatives Exchange, which is a government-owned exchange, Commodities Exchange of India. I was the earliest commodity trading mentor on the multi-commodity exchange, and I used to teach the diploma in commodities market, which was the approved course which was laid out by the Forward Market Commission, which was the commodities regulator before SEBI took over in 2015. Now, up to 2011, I was the consulting trainer at the MCX. My book also remains the only book to be enjoying the status as a recognized guidebook, and as of academic year 2017, it is the referral guide to commodities trading for SY BCom students in Mumbai University. Now, that said, let me just answer your question whether you should be going into commodities trading. Well, the answer is yes and no. If you're confused, let me just clear your confusion in the next few minutes. Well, you see, just because equities are going to be a lot more expensive where their derivatives are concerned to trade, you just can't be jumping ship and saying, okay, I want to go out for a movie. I'm not getting tickets for the movie that I want to go out and watch, but since I'm in a mood to watch a movie, let me just go out and go and visit another movie theater and watch another movie. That is entertainment. Maybe that works. But this is serious business. Money, your career, your hard-earned savings, your family, and your future security depends on these decisions. Can you really take a decision based on, this is too expensive, so trade, so let me just go out here and trade? I think you need to be a little more careful and consider a few more aspects which I am discussing now. Now, yes, margins are lower in commodities, but is it the only thing to consider? What about leverage? Now, leverage is a very simple concept. How much are you able to stretch your money and trade based on it? So, for example, a kilo of gold will cost you approximately 72 lakhs. Now, if you were to trade one lot of gold, 1 kilogram lot of gold on the MCX, your margin is 6,65,000, which is less than 10%. So your leverage is 10 times. All right. Now, when your capital is leveraged 10 times, your profits and losses are going to be bigger by 10 times as well. Is this something you're geared to handle? Are you skillful enough to be able to handle this? You need to answer that question. Now, let me just walk you through the margins that are prevalent in other commodities. Look, these are taken from my broker. They change from broker to broker and also from time to time. I'll explain why. Now, I'm talking of regular lots, front month series, the first month series, and they are as of today when I record this video. Aluminium 1,25,000 per lot, copper 1,85,000 per lot, crude oil 2,15,000 per lot, gold 6,65,000 per lot, lead 1,20,000 per lot, natural gas 40,000 rupees per lot. But do remember, the margin in natural gas is telescopic. It goes up and down. Now winter months are starting. You might see margins go all the way up to 1.5 or maybe even 2 lakh rupees per lot at the peak of winter. So leverage changes from time to time. Silver 4,35,000 bucks per lot. Zinc 1,50,000 rupees per lot. Now, before you start getting a sensation of your mouth watering, hey, this is a lot more cheaper than stocks that I trade in the F&O, the margin is much lower here. Do remember one thing. Every trade, every business has its peculiarities. And the peculiarity about commodities is that your span margin may be small, but your mark-to-market margin or mark-to-market loss rather can actually be bigger than your span margin. Now that is something a whole lot of traders don't know. Those of you who've been following me long enough on my social media handles, I have been debunking the commodity super cycle theory and I've been laughing it off. I mean, it's not something that I'm willing to consider. Since 2021, I've been telling people, look, it's a bull market. It's triggered by unbacked currency printing by central bankers around the world. It's causing inflation, and inflation is nothing but higher commodity prices. So let's not call it a super cycle. It's a man-made bull market by a combination of supply restrictions due to output cuts, etc., and currency printing. So if prices get volatile, and I gave you a recent example of copper, which people were touting to be in a super cycle since December 2023 right till July 2024. But ever since it fell more than 20% from its peak, as per the Dow theory, it went into a bear market. I told you per lot mark-to-market losses were in excess of rupees 2,50,000 INR. That's a 250,000 rupees loss. And what's your span margin in copper? 1,85,000. So if you think commodities are cheaper to trade, your span was only 1,85,000. Your mark-to-market loss was 120% bigger than the span. Are you aware about this before you want to jump into commodities trading? I'm not done yet. All right. Now, I just talked about span margin. Then from time to time, when volatility rises, particularly you will see this in natural gas in the winter months, there will be other margins like ad hoc margins. Ad hoc are temporary margins. Sure enough, they will be removed. They will be removed from time to time, but they will also be imposed when volatility rises. Then there are ELMs, extreme loss margins. Whenever volatility goes up, exchanges tend to levy ELMs, and ELMs can be pretty sharp, pretty steep. They can go up to 30, 40, 50%. Yes, silver fell in April 2011, end of April 2011, because ELM spans and ad hoc margins went as high as 50% in the global markets. And the collapse that we saw in silver from 76,000 rupees a kilo to sub 60,000 rupees a kilo in double quick time. Now compute what your mark to market loss would have been. The other aspect of trading commodities that you must consider before actually rushing into commodity trading is having domain knowledge. Do you know what kind of an animal you're trying to tame? Will you be able to tame this animal, or will this animal kill you? Now, this is something that every trader or a potential trader in commodity markets need to consider. Now, do you know the seasonality of each commodity? Now, for example, I told you natural gas will see telescopic margins. From 40,000, it might go to 1,50,000 or 2 lakh rupees per lot. Why? Because natural gas prices will start seeing the kind of volatility that nobody is used to seeing. The cost of carry or badla charges, financing charges, interest costs can go up, hold your breath, by up to 10, 15 and 20% per month. That's 120 to 240% annualized basis. Are you good enough to handle this kind of pressure? Ask yourself this question with a hand on your heart before you take any decision. Be very clear whether you can take this stress. What is the trigger that drives the price higher or lower of each commodity? Are you aware of what really works and what doesn't? Let me assure you, and no offense meant to any commodity analyst, commodity journalist, commodity watcher or commentator. I'm not throwing my weight around as the first author in the country or a trading mentor who started the first trading systems on the MCX. No, I'm just stating facts. The data that is available in the public domain, the official data, is incomplete. Why? I need to ask you one simple question. Have you ever been to Zaveri Bazaar? If you have been to Zaveri Bazaar and if you know the jeweler who you're buying, say, a piece of gold from, he might just come out and ask you, check or cash? Now, when he says cash, it means it's off the record, no bill will ever be made. Where does that bar of gold come from? It came from the parallel market. It's called smuggling. Are you aware about the data for how much gold is smuggled? It's very difficult to get. So can you go by the official data of India imported X number of tons of gold in this quarter? Hey, incomplete. There's another aspect of crude oil and natural gas trading which I'm confidently able to say that I'm up here when it comes to efficiency of data collection. There is human intelligence or HumInt, and there's open source intelligence or OSINT that we specialize in collecting. A huge component of crude oil and natural gas is sold in the unofficial or the ghost market. There are tankers that take this crude with no GPS transponders, or if they have transponders, they are switched off. Country markings, flags, identification papers of the crew are all taken off. They give and take delivery of this ghost inventory or unofficial inventory in the high seas where no country's laws apply. Deliveries are given in the middle of the night when it's pitch dark, so overhead satellites cannot spy on these ships. Do you have the capability, the network to kind of get even an estimated or a guesstimated figure of how much crude is being transported in a month in the ghost market? I wrote an article in Livemint on this subject. Unless you know what's happening in the official and the unofficial market, and you have human intelligence collection and open source intelligence collection capabilities of what's happening in the spot crude market in Asia, in Europe, and in the high seas, heed my request. Don't trade this market if you're not ready. I have no vested interest. I don't offer any services, advisory products, or softwares, or any kind of mentorship or training programs or whatnot. I've done what I had to do in life. I'm not interested in competing with these guys who are providing services. So I'm giving you advice. As a family man, do your family a favor. Get the regular and the required skills that are very different from equity markets before you dive into commodity markets. And remember, in the markets, there are the known knowns, there are the known unknowns, and there are the unknown unknowns. The unknown unknowns, which means data that is not available in the open domain. Like I said, tankers that deliver oil without transponders in the high sea in the middle of the night, oil that does not exist in the books of accounts. These are unknown unknowns. The fact that this oil trade takes place is a known unknown. The official data that Saudi Arabia is going to export so much oil in the month of September is a known known. So to be able to be a good trader in any asset class, you must master the known knowns, the known unknowns, and the unknown unknowns. Once you do that, you're the master of your own destiny. Welcome to commodity markets. If you ignore the fact that there was a polar vortex in the year 2021, polar vortex is because of global warming, the ice cap on the Arctic pole, the North Pole, starts to break away and huge chunks, miles and miles long chunk of ice starts to drift lower. They approach the seas in North America, Northern Europe, resulting in temperatures that are way below normal. Naturally, heating demand goes up, and what's better than natural gas for heating? Natural gas prices jump up. If at all you were to ignore this aspect, if at all you forget or don't know about where to get the data about a hurricane, tornado, or a storm coming in the Gulf of Mexico, you're completely ill prepared to trade natural gas and crude oil. If you do not know what to do about Latin America, now this is something I keep harping on my social media accounts. Keep watching LatAm, Latin America. This is something I wrote a complete article on my weekly column on moneycontrol.com. Said you can't be trading metals unless you follow the politics. I'm not talking of only manufacturing, mining, export. Unless you know the palace politics in Saudi Arabia, you can't trade oil and gas. Unless you know the politics of Latin America, you can't trade aluminium, copper, nickel, zinc, lead, tin, whatever. Are you able to garner this information accurately enough? Do you have the network to basically get this data from? Get it and then start trading commodities. Your body needs to be completely geared to handle the arduous long work hours that commodity traders need to put in. Market opens at 9 a.m., it shuts at midnight. 11:30 in the summer hours and midnight at summer times. Winter times in the US. So 15 hours a day is just trading time. You need at least 2, if not 3 hours. What's happening in Europe? What's happening in America? What's happening in Asia? Where did this market open and where did this close? What about the statistical data? What is the open interest? What is the price? What is the volume? You need to do a lot of number crunching. Mr. Narayan Murthy doesn't know that we commodity traders typically work 17 to 18 hours a day, Monday to Friday, and a minimum of 12 hours a day on Saturday and Sunday. Forget about 70 hours a week. Is your mind, is your body capable of handling this much of physical hard work? In this video, I have recorded how the mind and the body is impacted in trading. Cortisol poisoning, puffing up of the face, backache, cervical ache in the bone, shoulder ache, your lack of energy levels, thickening of the blood, your blood being unable to carry enough oxygen to the brain for correct decision-making processes. It's all explained in those trading psychology videos, part 1 and part 2. Do make it a point to watch these. Now, can you actually trade and dedicate 18 hours a day, Monday to Friday? Ask yourself this question. Are you in good enough health? Are you willing to make a sacrifice away from friends, family, outings, social life, etc.? It's not easy to jump into something without understanding what may be in store for you. If you think you're geared up to handle all these, then you absolutely should go into commodities trading. There's one promise Vijay Bhambwani is making to you. You're in for the time of your life if you're capable of doing all that. You will never be the same again. You will never look at the market same again, and you will be a born again trader. But if you're not ready, and give yourself time, you will be ready. The skills that I'm talking about are, grammatically incorrect word, learnable. It is possible to learn all these. Yes, it is possible. You can do it. So wait for yourself to be ready before you jump in. Like I keep saying, we traders are brain warriors. We win and lose with our mind. The second aspect that you must remember is that there are 3 objectives that every trader must fulfill. He must make the most amount of money, he must make it in the shortest possible time, and he must make it with controlled risk to his capital. Now, risk, as Warren Buffett says, comes not from doing something or not doing something, but risk actually comes from not knowing what you are doing. So don't shoot arrows in the dark, don't throw darts in the dark. Be true to yourself and your family by first getting the skills. Friends, before I sign out of this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how you like my videos and what you'd want me to record next. Also, please share this video with smart guys like yourselves and help me reach out to a wider audience. Thank you for your patience in being with me in this video. Till we meet in my next, this is Vijay Bhambwani signing off for now. Take care. Bye-bye.